Most small business owners are working hard, but still feel blind when it comes to money. They see revenue coming in and expenses going out, yet the bank balance keeps surprising them. In this Business Finance Advanced Masterclass, we are going deeper into the systems that actually control business money with practical examples. Chapter 1: Working Capital, Inventory, and Daily Money Control. Working capital is where business finance becomes painfully real on a daily basis. It decides whether salaries go out on time, suppliers stay supportive, and growth feels smooth or stressful. Working capital is calculated as current assets minus current liabilities. But behind this simple formula lies deep operational discipline. Start with inventory management. Inventory is cash wearing a different shape. When inventory grows faster than sales, cash gets trapped. For example, if a business holds inventory worth $200,000, but monthly sales support only $100,000 of movement, excess stock locks up $100,000 unnecessarily. This creates storage costs, risk of damage, and price discount pressure. Next is accounts receivable management. Credit sales increase revenue but delay cash. If customers take 60 days to pay instead of 30, the business must fund 2 months of operations without receiving money. For instance, monthly credit sales of $100,000 with 60-day terms create receivables of $200,000. That money cannot be used elsewhere until collected. Then comes accounts payable strategy. Paying suppliers too early strains cash. Paying too late damages trust and supply continuity. Smart businesses negotiate payment terms that match their receivable cycle. If receivables are collected in 45 days, payables should ideally be settled in 40 to 50 days. This balance keeps cash moving. The combined effect of inventory, receivables, and payables forms the working capital cycle. When this cycle stretches, businesses feel permanent cash pressure even with growing sales. When it tightens, cash stress reduces dramatically without increasing revenue. Another important term is operating liquidity buffer. This is the minimum cash reserve required to cover fixed expenses for a defined period. If monthly fixed costs are $40,000 and the business keeps 3 months of buffer, the liquidity reserve should be $120,000. This buffer protects against delays, slow seasons, and unexpected costs. You must also understand cash forecasting. A rolling cash forecast projects inflows and outflows for the next 3, 6, or 12 months. For example, if expected inflows for the next quarter are $300,000 and expected outflows are $320,000, the business must plan funding or cost adjustments early. Another powerful concept is just-in-time inventory, which reduces storage and cash lock-in by ordering materials close to production needs. While not suitable for every business, it improves cash efficiency when applied carefully. Businesses also need credit control policies. These define who gets credit, for how long, and under what limits. Weak credit policies create bad debts and legal costs. Strong policies improve cash predictability. Working capital is not about growth alone. Rapid growth often worsens working capital stress. Higher sales require more inventory, more receivables, and higher expenses before cash arrives. This is why many fast-growing businesses fail. Owners who master working capital, control gain stability, bargaining power, and calm decision-making even during expansion phases. Chapter 2: Budgeting, Forecasting, and Financial Planning for Control. Budgeting is not about limiting growth. It is about controlling direction. Many business owners avoid budgets because they think budgets kill flexibility. In reality, budgets create clarity. A budget is a financial plan that estimates future income, expenses, and cash needs for a defined period, usually 1 year. Without a budget, decisions are emotional. With a budget, decisions become strategic. Start with a revenue budget. This is based on realistic sales assumptions, not hope. For example, If a business sells an average of $80,000 per month, projecting $150,000 without clear drivers creates false confidence. Revenue budgets should be built using pricing, volume, seasonality, and conversion rates. Next comes the expense budget, which separates fixed and variable costs. Fixed costs like rent, core salaries, insurance, and software must be covered even if sales drop. Variable costs like raw materials, logistics, commissions, and packaging rise with sales. If fixed costs are $40,000 per month and variable costs average 40% of sales, this structure defines how much revenue is needed to stay profitable. Then we move to cash flow budgeting, which is far more important than profit budgeting. Cash budgets track when money actually enters and leaves the bank. For example, sales made in January may be collected in February or March, while salaries and rent are paid immediately. Ignoring timing leads to cash shortages even when annual budgets look healthy. Another essential tool is financial forecasting. Forecasting differs from budgeting because it adjusts continuously. A rolling forecast updates future projections based on actual performance. If first quarter sales are lower than expected, the forecast adjusts costs, cash needs, and growth plans early instead of reacting late. You must also understand scenario planning. This involves building best case, expected case, and worst case scenarios. For example, if expected monthly revenue is $100,000, the worst case scenario might assume $70,000, while the best case assumes $130,000. Each scenario should have predefined actions. This removes panic during uncertainty. Another important term is variance analysis. This compares actual results with budgeted numbers. If marketing expenses were budgeted at $10,000 but actual spending is $15,000, variance analysis forces a question. Was the extra spending planned, accidental, or inefficient? This discipline prevents silent financial drift. Capital planning is also part of budgeting. Capital expenditure planning estimates spending on long-term assets like machines, vehicles, and technology. These decisions affect depreciation, cash flow, and loan requirements for years. Budgeting creates financial accountability. Departments, teams, or managers are assigned responsibility for specific cost categories. This does not mean control through fear. It means clarity through ownership. Businesses that budget do not eliminate risk. They reduce surprise. And in business finance, fewer surprises mean better sleep, better decisions, and stronger long-term growth. Chapter 3: Debt, Loans, Interest, and Smart Use of Leverage. Debt is neither good nor bad by itself. Debt is a tool. Used correctly, it accelerates growth. Used carelessly, it destroys businesses that look profitable on paper. Understanding debt begins with knowing the difference between productive debt and stress debt. Productive debt funds assets or activities that generate more cash than the cost of the loan. Stress debt is taken to cover losses, delays, or poor planning. Start with term loans. These are repaid over a fixed period with scheduled installments. For example, a loan of $200,000 at 10% annual interest over 5 years creates predictable monthly payments. These loans are suitable for equipment, expansion, or long-term projects. The key is matching loan tenure with asset life. Next are working capital loans. These include overdrafts and revolving credit lines. They help manage short-term cash gaps, but should not fund long-term assets. Using short-term loans to buy long-term equipment creates constant refinancing pressure. You must understand interest cost and effective interest rate. A loan with a flat interest rate may appear cheap, but can have a high effective rate when calculated correctly. Always evaluate total interest paid over the loan life, not just the advertised rate. Another critical concept is debt service coverage ratio, often called DSCR. This measures whether the business generates enough cash to repay debt. If annual operating cash flow is $150,000 and annual loan repayments are $100,000, the DSCR is 1.5. Lenders usually prefer ratios above 1.2 to 1.5. You should also understand collateral and personal guarantees. Collateral reduces lender risk by securing the loan against assets. Personal guarantees shift business risk to the owner. Smart entrepreneurs negotiate terms that protect personal finances whenever possible. Debt also affects the balance sheet leverage. High leverage increases return during good times, but magnifies losses during downturns. This is why debt to equity and interest coverage ratios matter. If interest expense consumes a large portion of operating profit, flexibility disappears. Refinancing is another important tool. Loan restructuring can reduce monthly burden, extend tenure, or lower interest. However, refinancing should be strategic, not reactive. Constant refinancing signals weak cash discipline. You must also understand covenants, which are conditions imposed by lenders. These may require maintaining minimum cash levels, profitability, or ratios. Violating covenants can trigger penalties or early repayment demands, even if the business is still operating. Smart debt management includes a repayment strategy. Extra cash should sometimes reduce debt instead of funding expansion. Lower debt improves credit profile, reduces stress, and increases long-term resilience. Debt should serve the business, not control it. Owners who understand leverage use debt as a growth partner, not a survival crutch. Chapter 4: Financial Ratios, Performance Metrics, and Decision Intelligence. Numbers alone do not create insight. Interpretation does. This is where financial ratios and performance metrics turn raw data into decision-making intelligence. Ratios allow business owners, investors, and lenders to quickly assess health, efficiency, risk, and growth potential. Start with profitability ratios. These include gross margin, operating margin, and net profit margin. If revenue is $1 million and net profit is $100,000, net margin is 10%. Tracking margin trends over time is more important than one strong year. Declining margins often signal rising costs, pricing pressure, or operational inefficiency. Next are liquidity ratios, which show short-term survival strength. The current ratio and quick ratio measure the ability to pay obligations without stress. If current assets are $200,000 and current liabilities are $150,000, the current ratio is 1.3. Ratios below 1 indicate danger. Ratios that are too high may signal idle cash or poor asset use. Then come efficiency ratios. These include inventory turnover, receivables turnover, and payables turnover. If average inventory is $100,000 and cost of goods sold is $600,000, inventory turnover is 6 times per year. Slow turnover ties up cash and increases risk of obsolescence. Return ratios are critical for owners and investors. Return on assets shows how efficiently assets generate profit. If net profit is $100,000 and total assets are $500,000, return on assets is 20%. Return on equity shows how effectively owner capital is used. High returns attract investment but must be balanced with risk. Another important metric is break-even margin of safety. This shows how much sales can fall before losses begin. If break-even revenue is $200,000 and actual revenue is $300,000, the margin of safety is $100,000. Higher margins of safety reduce anxiety during slow periods. You must also understand cash-based metrics, not just accounting ratios. Operating cash flow margin, free cash flow yield, and cash return on capital show true financial strength. Profit without cash metrics is incomplete analysis. Modern businesses also track unit economics. This includes customer acquisition cost, customer lifetime value, contribution margin, and payback period. For example, if acquiring a customer costs $50 and the customer generates $200 of gross profit over time, the business model is strong. If acquisition cost rises faster than lifetime value, growth becomes dangerous. Another powerful concept is trend analysis. Ratios should be compared across months, years, and competitors. A single number means little without context. Consistent improvement matters more than perfection. Metrics must drive action. Numbers that are measured but ignored waste time. Every ratio should answer a question and trigger a decision. Financial intelligence is not about complexity. It is about clarity, consistency, and disciplined response to what the numbers are quietly saying. Chapter 5: Risk Management, Controls, and Financial Safety Systems. Strong businesses do not avoid risk. They manage it intentionally. Financial risk appears long before losses are visible, which is why risk management systems are a core part of business finance. Many failures happen not due to low sales, but due to weak controls and unplanned shocks. Start with financial risk types. These include liquidity risk, credit risk, operational risk, interest rate risk, and concentration risk. Liquidity risk arises when cash inflows and outflows are poorly timed. Credit risk appears when customers delay or default on payments. Operational risk includes fraud, errors, and system failures. One essential protection tool is internal financial controls. These include separation of duties, approval limits, documentation standards, and audit trails. For example, the person approving payments should not be the same person reconciling bank statements. This simple rule prevents many silent losses. Another key system is expense authorization control. Businesses should define who can approve expenses and up to what limit. Without this, small untracked expenses slowly drain profits and cash. Monthly expense reviews act as early warning signals. You must also understand cash control mechanisms. Daily bank balance checks, weekly cash summaries, and monthly reconciliations help detect issues early. Unreconciled bank statements hide errors, missed payments, and fraud risks. Insurance is another risk management pillar. Business insurance protects against unpredictable losses such as fire, theft, liability claims, and operational shutdowns. Insurance premiums may feel like unnecessary costs until one incident threatens survival. Another critical concept is financial diversification. Relying on a single customer, supplier, lender, or product creates concentration risk. If one customer contributes 40% of revenue and delays payment, the entire business suffers. Diversification stabilizes cash flow. Emergency planning is equally important. Emergency funds act as financial shock absorbers. If monthly fixed costs are $50,000, holding reserves of at least 3 to 6 months provides time to adjust during crises. Emergency funds are not idle money, they are survival capital. You should also plan for interest rate risk. Variable rate loans can increase repayment burden during rate hikes. Fixed rate structures provide predictability. Understanding loan terms prevents surprises. Another overlooked area is compliance risk. Late tax payments, incorrect filings, and regulatory violations attract penalties and legal costs. Compliance discipline protects cash and reputation. Risk management is about mindset. Financial safety is built before problems appear, not after. Systems, controls, buffers, and reviews create resilience. Businesses that invest in risk management grow with confidence because they know one unexpected event will not wipe out years of effort.